So I think we can just start. I will not waste much time. I won't waste time. I want us to look at assurance and non-assurance engagement. So this basically what you need to know is that we have assurance engagement. These are engagements where the auditor or practitioner needs to give conclusion at the end of the engagement. That is assurance, meaning that he's going to assure the users of the information. He's going to raise their level of confidence. That means that he has to give an opinion at the end. He has to give conclusion. But non-assurance engagement, the auditor doesn't need to give conclusion. So when we talk about non-assurance and then assurance engagement, we are talking about two situations. Number one, this one, in assurance engagement, this is where the practitioner has to give conclusion. And then we have non-assurance. He doesn't need to give any conclusion, or is not expected to give any conclusion. So that is the difference between the two. Now, examples of assurance engagement, we know that we have audit of financial institutions, audit of historical informations, financial information. Those are examples of assurance engagement. So that is one. We also have a system assessment. We also have compliance assessment or compliance audit. We have review engagement. Those are examples of non-assurance. Those are examples of assurance engagement. Then we have non-assurance engagement. Non-assurance engagement examples. Number one, we have agreed upon procedure. We have compilation report or compilation engagements. Those are engagements where you don't need to give any conclusion in the report. So we have those two. Just 1 minute. We have compilation engagements or compilation report. We have agreed upon procedure. We also have bookkeeping, which you can call accounting. Then we have tax return. Tax return services or services. Yeah. So those are examples where you don't need to give any kind of conclusion. So in exam, they might ask you to explain any of these, or they can ask you to state a few examples of non-assurance engagement. Then you can be able to state these ones. So agreed upon procedure, this is basically where the client agrees with the auditor or the practitioner that we are going to make this report in this way. So there's a manner it is expected to be prepared. In this particular case, it might look like an audit, but it's not an audit because we are not using the procedures that we are supposed to use, which is the ISA standards. So the reports are actually done according to the agreement, and that is why it's agreed. They agreed upon the procedure that is going to be used. So the client and the auditor agrees upon the procedure that they're going to use to make a report. That is why the name agreed upon procedure. Then we have compilation report. To compile, I know you know what it means, just to bring things together, maybe to consolidate or compile. So that means that in a situation, for example, a good example is where probably the client has been able to prepare good accounts. He has prepared good accounts, but he actually has a problem in drafting. The bookkeeping has been done, but he cannot draft so that he can have a situation where the reports have been compiled to show the section for profit and loss, and then balance sheet, changes in equity, cash flow. He doesn't know how to do that. So he can actually come and tell you that you come and draft for him. Remember, you're not doing an audit, so you cannot be able to explain whether those figures are true or not. But what you're basically doing, you are assisting the client to compile them or to put them together. So that in that case, it is not assurance because you can't raise any level of confidence. You can't tell whether the figures that you are working with are true and fair. You cannot say that. So that is why it is an assurance engagement. You are not going to give any assurance on the report. And even agreed upon procedure, you can't give assurance because you are not using the standard that is expected for audit. You are doing something like that looks like audit, but you are not doing audit because you are not able to follow the ISA standards. That is the international standards of auditing. You are not following international standards on auditing. We have bookkeeping. This is where you're giving accounting records. Somebody is telling you that I have records. Can you just do for me bookkeeping or keep for me records? So your work is only to come and post them. You are not analyzing or trying to check whether those figures are true or not. You are only using what you're given, then you post, and that is done. So then you cannot give a report whether they are true or not. That is another example. Then we have tax returns, where somebody is telling you, can you file for me VAT, PAYE? You are only filing what you are getting there. You don't have that opportunity to go and check whether the source are actually relevant. Like in our last class, we talked about good reports. How can you know that this evidence is a good evidence or reliable? You're not checking or getting any evidence to be able to support whether they are okay or not. So that is why these particular services are considered to be non-assurance. You're not going to give any assurance to the users of the information. Now, the next stage that they normally ask in topic 1, they will ask you about elements of assurance engagement. These elements are the best way to differentiate between assurance engagement and non-assurance engagement. So they will ask you about elements of assurance engagement. So the first one, these are the things that when you see, you can easily know that this one is an assurance engagement. The first one, first element is that it has three-party relationship. Three-party relationship. The first person here is the practitioner, that is the auditor. The second person here, responsible party, this is the person who keeps the book. Remember, you are going to audit, like in audit or system assessment, you are going to review it or audit it. Somebody else was given the responsibility to take care of it. So that is the person that we call responsible party. They take care of the subject matter. Subject matter is the item that you're auditing. And then we have practitioner. This is the examiner or the auditor or examiner. You can also call it inspector. It has inspection, eh? So it is also called inspector. Then we have users of the information. So this is basically the third person that we're talking about, the users of the information. And this particular person will be in the form of employees. These are the people who want to use the report that you are giving out. They're interested in assurance report. They're the people that you're going to assure or you're going to raise their level of confidence. So examples are employees. They are so interested on this report. We have investors. We have government. We have government agencies. Then we have creditors. We have shareholders. We have competitors. Now, in exam, if they ask you who are the users of financial information or who are the users of report, then these are the people that you need to mention. They are the ones who use such kind of report. They're the users of the report. All right. So this is the first characteristics of an assurance engagement or elements. In exam, they can ask you the elements or characteristics or features. These are the ones that must be there for assurance engagement to be called assurance engagement. For an engagement to be called assurance engagement. Now, after number one, we have number two. Number two, we can think about maybe the subject matter. Is the item under investigation? Item under investigation. So this particular subject matter should be something that it is the thing that is being audited or investigated. This particular subject matter should be identifiable and it should be appropriate. You should have something that you can easily identify that I'm going to audit system. I know what system is. I can identify it. I'm going to audit maybe land. I can identify land clearly. So it should be identifiable. But again, we are saying that it should be appropriate. That means that we should be able to even know the criteria that we should use to audit it. We should be able to know when I'm going to audit it, is this something that is auditable? I can identify it, but is it appropriate? Can it be auditable, right? I have the criteria because when you're auditing, there must be benchmark that you're using to audit that particular item. If it doesn't have the criteria, then there's no way you can be able to audit. Then that brings us number three, where we're talking about suitable criteria. So this one is basically the benchmark used to audit the subject matter. So criteria, if somebody asks you, what is the criteria? What is the standard? What is the benchmark? So it is a standard or benchmark. For example, if I'm auditing maybe I'm auditing loans, I want to see the non-performing loans. I need to look at the regulation. What is the regulator saying about non-performing loans? What is the criteria for auditing? What is the layout or framework? That is what we're talking about. When you're auditing compliance, what are you confirming it with? What are you confirming? What is the framework that has been given by NEMA or maybe KRA so that I can know that this client is compliant? So that thing that you're using as the benchmark, which you compare, this one is the benchmark I'm comparing with the actual, which is the subject matter, then I can be able to know that we are actually, there is deviation. We are deviating from what is expected. Then that is now what we call the suitable criteria. It could be constitutions. Like now, when somebody has been actually arrested, Amanda Kotini, the judges will always use some criteria to be able to charge this person. They compare what has been done with what the constitution says or penal code. And then they can say that this person, he went against what is expected. So that constitution in that case probably becomes the benchmark. Number four, we have sufficient and appropriate evidence. When we talk about appropriateness, we are talking about reliability. Can you rely on it? Then we talk about sufficient. So this one is basically quality. Then when we talk about sufficiency, we are talking about the quantity. If you remember from our last class, we talked about quantity. When you're talking about quantity, you think about materiality. And the quantity of evidence that you're collecting also depends on some issues. In our last class, there was a question that was asking, what are we supposed to check when we are trying to consider the quantity of audit evidence? So this is the evidence. Now we're looking at the sufficient, whether it is sufficient or not, meaning that we're thinking about quantity. So what determines the quantity? So in exam, they can ask you two questions from here. Number one, what determines the quantity of audit evidence? Also, they can ask you what actually affects the reliability, or what you need to consider when you are trying to look at the reliability of the audit evidence. Now, quantity is determined by the number one, the risk that is expected. If the item that you are auditing, which is the subject matter here, is exposed to a lot of risk, then you need to collect more evidence. The higher the risk, the higher the evidence, right? You need to collect a lot of it so that you can give weight to it. Because if, for example, you are auditing maybe payroll, that I give example with, and you realize that there's a lot of risk here, then it means that when you're now auditing, you need to collect a lot of samples to be able to know the quantity of loss that has been suffered, right? So you might realize that out of 100 staffs, their salaries have been overstated. Out of 100, maybe 900 are overstated. That is a high risk. There's a possibility, high possibility of losses here. So it means that you need to collect a lot of evidence so that you can estimate what you are trying to come up with. You can be able to know how much is the loss. But if you realize that the risk is low, then you just put a few, you just take a few, because internal controls are okay, just pick a few. Then you say that if these few ones are okay, then we can assume everything is okay. So the lower the risk also, the lesser the quantity. Another thing is the level of assurance that is expected, or surety, or the level of confidence. If these people are telling you are auditing, but they're telling you that they need you need to give a higher level of confidence, meaning that if you give a lower level of confidence, then there is something that is called audit risk. You're actually exposing yourself. So what happens? You need to collect more evidence so that you are sure that up to here, I think I've done everything that was humanly possible. In fact, if you can be able to audit each item, each sample, or each member of the population, so that you can be 100% sure that there is nothing that you forgot. That means that you are trying to reduce the audit risk, the risk that is you are going to give, the chances that you're going to give a wrong conclusion, you have reduced, meaning that there is a high possibility that you are 100% true, and 100% correct. So that means that you've raised the level of confidence. So that is why I was saying, whenever there is an expectation, a high expectation in terms of the level of confidence, then you have to audit a lot of things so that you can give a report that is quite of high quality. Another thing that determines the sufficiency or the quantity of the evidence that you're collecting is probably something like the amount of population. Population is the totality of the subject matter, or totality of the items under investigation. If you are auditing payroll, then the whole personnel in that payroll is the population. Now, if the population is higher, definitely you need to get a lot of samples and audit a lot of items, then have them as part of your evidence. But if there are few, there are only 10, then obviously you can't go and collect 12. So again, the number of evidence that you require also depends on the amount of population that you are investigating. So the higher the population, the higher the evidence that you need. Just the same way right now we are in election period. You cannot go and sample in Nairobi County. You go and sample maybe 100 people, then you say that they have suggested they're going to vote for this particular candidate. You go and collect the same 100 people in Wajir, where population is lower, then you again assume that those 100 people are good representation of those people. These people are not in the same level. Whenever you are in Nairobi, you need to collect more evidence. That means that more sample compared to an area with less population. So that's why we are saying, if the number of population is higher, then you need to collect more evidence so that at least you can be closer to the truth. Those are things that they can ask you. Now, in terms of reliability, they can ask you questions. What do you need to consider to say that the financial statements are quite reliable? Here, we are talking about the quality of that report. In our last class, we talked about the quality, factors that affect the quality of evidence that we're talking about. They can also ask you in terms of reliability, what you need to consider to say that this report is quite reliable. Number one, we say that a document that has been maybe received or generated, a document that is generated from the original, a document that is generated from the original source is better than the one that is generated from copies. Just 1 minute. Okay, so document that is actually generated from the original source is better than a copy because copies can always be manipulated. Even if you get a colored copy, you might not know what they have done on it. It might not be, it can still be fake. Number two, a document that maybe an evidence that has been collected by the auditor himself. When the auditor like you, ile kitu umejionea ni tofauti na ile umeambiwa na mtu, sindio? So the ones that have been collected directly by the auditor, that is a good evidence. So what I'm trying to say here, examiner can come and ask you a question. Instead of asking you to give elements of assurance engagement, they come to one element here and set so much questions here that it can even be 10 marks. They can ask one in terms of quality, then they come here. That is what they normally measure on. So then you wonder that all of these, they are not able to set you direct question. So the one that is collected by the auditor himself is a good evidence. And next evidence is the one that the auditor is able to get directly from the system, the client system. If the auditor is able to generate it directly from the client system, especially where internal controls are very effective, then that is a good evidence. Remember, most auditors will audit around the computer. They tell you, go and print for me this, go and print for me this, go and print for me this. But they are not coming to do it themselves. They can't be sure what you did when you are printing. And so, since we come as auditors, when we are going to request for record, the client will tell me, Dennis, wait, I'll get you that report tomorrow. Unataka hii ledger, let me work on it. I'll give you tomorrow. So what does that mean? What does that mean? He's going to work on it, and I don't know what he's going to manipulate and give me the report that favors it. So why can't I just generate it by myself? I can do it alone through the system. So that is a good evidence when it is actually received directly from the system. So another good evidence is the one that the auditor has been able to get from a third party. An independent third party. An independent third party also give a good evidence. For example, third party like a bank that is independent. Those people will say the truth compared to the one that the client is giving me. If the client gives me directly, then the client might lie. He might only tell me what he feels will favor him. But now, if I send a letter to that party, he will tell me the truth, especially when it is independent. So when you're giving that point, say, evidence received from independent third party, that is a good evidence than the one that you collect from the client. The client might lie, might give you only what favors him. So, okay, so we have looked at the fourth element. The fifth element is the report. We said that in assurance engagement, you have to give a report, right? And that report should be an opinion or conclusion that helps to raise level of confidence, not just report, but the report that will help to raise level of confidence. So that is why, number 5, you can talk about report or conclusion about all that's done. So in exam, if they ask you about elements, this is basically what you need to look at. Okay, so in exam 2018, that is under AA, intermediate level, AA, they were asking questions like in May 2018, you can write down May 2018. May 2018. May 2018, they were asking, that is under AA, May 2018, question 4C. Question 4C, they were asking, distinguish between assurance and non-assurance engagement. Now you can know the differences. We say that under assurance engagement, This is an assurance or an assignment in which a practitioner expresses a conclusion. It is an assurance, it is an engagement, that is assurance engagement. It is an engagement where the practitioner expresses a conclusion designed to enhance the degree of confidence. That conclusion is designed to increase the level of confidence. So it is enhanced to increase the degree of confidence of the users of the report. Tuko pamoja, an engagement where the users, the practitioner, who is the auditor, is expected to give a conclusion, and that conclusion is designed in a way that it should increase or enhance the degree of confidence on the side of the user, the degree of confidence of the users. Then you say, on the other hand, non-assurance engagement, the practitioner is not expected to give any kind of conclusion. Sawa. Is not expected to give any kind of conclusion that is aimed at boosting the level of confidence. Is not expected to give any results or any conclusion that is expected to increase the level of confidence. That is basically the difference. That is, if they give you 2 marks, then you can explain like that. But if they give you more marks, like 4 or 6, then they told you to give differences between assurance and non-assurance engagement. After giving the first difference, which is basically the definition, the second difference may happen, these ones. Under non-assurance, we don't have suitable criteria that we compare. There is no benchmark. Yenye unaangalia ati hii inafaa ikuwe hivi, but they have done this. There is no benchmark. That is one. The other one has, assurance engagement has. Number 2, look at the first point that we gave. We gave the first point 3-party relationship. And the third party was the user of the information. This is the person that you need to raise the level of confidence. But under assurance engagement, there is no such things. Under an assurance engagement, there is not that such thing. Probably somebody has called you to assist him do VAT. There is no 3 people. Utapata, the responsible party is lazy, is the management, is lazy, ama hana enough capacity, anakuambia kuja nifanyie kazi. So it is only between you, the practitioner, and the responsible party who has delegated to you that job. So we don't have a separate person who is that person like user. The government is not interested in this. Competitors are not interested in this. And even investors, they don't even know that you should do something like that. And even if you give them the report, will not help them because they don't understand anything there. It does not give any opinion. So they don't expect to use your report. The only person who wants your report is the responsible party, who was the management. He was busy, he didn't have time, akakwambia nisaidie kutengeneza hii report. And that report is only probably bookkeeping. So we don't have 3-party relation in an assurance engagement. The next difference that we have is sufficient evidence. You are not being told to gather sufficient evidence when you're doing bookkeeping. No. Ile amekupea hata kama ni moja, unaweka ukienda. When you're being told file, you only file and go. You don't need to collect evidence. There is nothing that you're going to defend. It is not going to be used anywhere. So again, that is also another difference. So in case you're giving 3 marks or any more marks and they told you to differentiate between the 2, then use part of these, explain in a way that shows differences. Tuko pamoja? Okay, of course, subject matter appears in both. Subject matter appears in both because it is the item that you are working on. That item might be bookkeeping, is the subject matter, but you might not be able to give any conclusion on it. Okay, let's look at another question. In May 2019, do we have anybody in advanced level here? Just say yes if you are there, so that I can look at one question from your level on the same topic because it is a common topic. In May 2019, they were asking question number 2, explain 3 key elements of an assurance engagement. So you can pick any of these. Explain 3 key elements of an assurance engagement. When they talk of key elements, you can pick any of those. You can talk about the suitable subject matter, or just say subject matter. You can be talking about maybe evidence. You can talk about appropriate evidence, then three-party relationship. You can pick any out of these ones that you have. If they ask you about 3 or 4 elements, that is direct. Na unapata max yako. Any person from advanced level? Kama kuna, let me check if we have anybody. Oh, Nicholas is here. I repeat number 5. Number 5 is about report. Number 5 is the report or conclusion. Number 5 is the report or conclusion. So number 1 was a three-party relationship. And the three-party that appears as part of the elements, number 1 was three-party relationship. Those three-party, number 1 is the practitioner himself. There are 3 people: the practitioner, the responsible party, and the user of the financial information or the user of the information. And we're giving an example of an audit. An audit, that particular report is being gazetted because it is going to be used by people who are users of the information. Then we have the management. The management must be there. These are the people who keep the subject matter. They make sure that the subject matter is safe, is in good order, well kept. That is the management. Sometimes we call them responsible party. And then the other party is the auditor mwenyewe. Those are 3 people. So when you are asked, the first point is say three-party relationship, then now mention those 3 parties. The practitioner number 1, responsible party number 2, then we have the third one, the users of the information. Nicholas, you are in advanced level, so I can look for one question in advanced level, then we move. But you can also suggest maybe a topic that you want us to look at. So under advanced level, they normally raise the bar kidogo. They raise the bar kidogo. Yeah, the same things, but they don't give you direct like intermediate. Though you need the experience, you need the knowledge here so that you can be able to ask, to answer questions. They normally give a question like maybe case study. We can look at one of them. It's May 2015. Just write somewhere. May 2015. May 2015. Question 3, that is under advanced level. They gave us question here, case study. Na even inakuanga saa zingine. John Matthew and David commenced a partnership business in January 2014. Using a bank loan for finance, they used a bank loan to start a business. The business retails luxury handmade furniture currently in a single retail outlet. Revenue for the first year of trading was 90 million. Their first year of trading in this partnership was 90 million. The partners projected a rapid growth in the next few years. So they knew that now that we have started and revenue is okay, I think in the next few years we can be doing well. The 3 partners are aware that partnership is not required to subject its annual financial statement for audit by external auditors. By the way, the Companies Act only requires limited companies to be subjected to audit. Something like sole proprietorship and partnership are not mandatory for audit. But even these limited companies, there are ones that are considered to be small companies. Like if they are saying that if your revenue is less than 5 million and you are a private limited company, and your revenue is less than 5 million in a year, you don't need to do audit. Or alternatively, if your asset is less than 20 million in a year, you are not expected to do an audit. But if it is limited company, which is public limited company, just as a public kuna pesa ya wenyewe, pesa ya wananchi, that one, it is actually expected to do an audit. You are expected to do an audit, even if you don't have that revenue. Hata kama revenue ni 100,000, you need to do an audit because you have people's money, you have to account for it. So it is mandatory for public limited. But private, ni kama sasa kampuni ya mtu enyewe. It is only requirement if you have revenue of 50 million or an asset base of 20 million. So this guy, they are partners, and they know very well that there is nowhere written in the law or act that a partnership or sole proprietorship must do audit. They know. Kwa hivyo wanaona kuna haja ya audit. However, they are unsure whether there will be any benefit of a voluntary audit. They don't know whether if they do voluntary audit, because not mandatory, they will get any benefit of the first financial year. Financial statement, the first year's financial statement. So, okay. The partners are also aware that a review of the financial statement could be performed as an alternative to a full audit for bank purposes. So, a review, they are talking about review. When somebody tells you review basically means ni kupitia juju. You're just going through it. Like now at your place of work, your manager will always tell you, Eric, let me review that report before you send. Wacha nipitie. She's not going to, he or she is not going to redo the report. Lakini anapitia juju kabla utume. So that is what we mean by review. So review and audit are the same. The only difference is audit is in-depth examination, but review is just perusing through. It is not in-depth examination. So the big difference between review and audit is that the extent, or we can call it the scope, is actually limited on review. Tuko pamoja? So in exam, they can ask you, those who were with me when I was starting, I talked about a review engagement as part of an assurance engagement. So review and audit are like brothers, they are neighbors. The only difference is moja ni refu, the scope is quite deep, and the other one is shallow. Now, this guy is saying, instead of calling an auditor, because it's even expensive to do audit compared to review. Review unaambia mtu kuja upitie, uniangalie tu financials, then you tell me what you can see. So it can be done within a day. But audit, you need to go deeper, examine and assess a lot of records. So this guy is saying that instead of calling for a normal audit, why can't we just call for a review? After all, it's not mandatory. And remember another difference between review and audit. Audit is the one that is required by law. It is a statutory requirement to be done. Nakwambia differences. In exam, they will ask for the differences. I've given you two already. I talked about in terms of extent. The other one is in-depth examination. This one is just a review, or we can say shallowly. You just do it shallow examination. Then the other one is scope. The scope is wide in audit, but in review, the scope is limited. Another difference between review and engagement now, statutory, it is a statutory requirement for audit to be done. Audit is a statutory requirement. Review is not required anywhere. It is not a statutory requirement anywhere because it doesn't give the exact position. Number three, the difference in review and audit is that in review, the level of confidence is actually low because you didn't do thorough work. Huwezi ambia mtu ati I'm assuring you 100% ama 90%. How to angalia vitu mingi. So we are saying the level of confidence is actually low in review. But in audit, there is normally higher level of confidence. You umefanya kazi safi, umefanya kazi mingi. Another difference is in terms of reporting. Under review, the report is normally negative opinion. When you talk about negative opinion, this is an opinion where the auditor is always not sure. Hajafanya kazi mzuri. So anasema, mimi nimepitia hii kitu, lakini vile nimeiona, there is nothing that shows that financial statements are not okay. But it's not coming out openly with confidence and telling us that the financial statements are okay. No. He's only saying that according to our examination, there was nothing showing that the financial statement, or nothing has come to our attention to show that financial statement has errors. Unaona? Meaning that anajidefend to that vile tumeangalia mimi sijaona makosa, lakini atuambii that things are okay. Unajua kama hujaona makosa, haimaanishi that there is no makosa. Ni wewe ndio hujaona, but there's a possibility is there. Tuko pamoja. So under review, the kind of audit opinion is normally negative. They have negative tone. Then are normally doubtful. They are saying nothing has come to our attention to show that financial statements are misstated. Under audit, you have so much confidence. You say that according to us, the financial statement represents a true and fair view. You don't tell us what you fail to see. Tell us what you know, not what you have not seen, what you know. So that is what it is called a positive report or positive opinion. Sawa. You either tell us that they are okay or they are not okay. Hakuna, no beating around the bush ati haujaona, ilifaa uone, nini, no. Because you did a good job and you should be very confident. So that is another difference. The next difference between a review and engagement, na hizi wanauliza kwa exam by the way. The next difference ni kwamba, under review, the audit risk is normally higher. Audit risk is normally under review. So audit risk is that risk that the auditor can give a contrary opinion apart from the correct one. Yani, umefanya audit, then you realize that the opinion that you should have given was a clean bill, but you gave a wrong one. So it means that you are giving a contrary opinion from what is actually the fact. That is a risk. As an auditor, that is a risk. Whether you are giving the correct one when things are wrong, or you are giving the wrong one when things are okay, both of them are risk. So that is what we call audit risk. It is the risk that the auditor can give a wrong opinion. It is the risk that the auditor can give a wrong opinion. Under intermediate level, they will ask you, what do you mean by audit risk? Then they ask you the types of audit risk, right? So that is the risk. Now, they will ask you maybe, not the types, but they call it the elements. Yes, elements of audit risk. So that is what it is. So in a review, the audit risk is very high because the auditor mwenyewe hajafanya kazi mzuri because of limitation of scope, alikuwa anapitia tu, so he can't be able to tell us the truth. He can't be sure. So because of the extent of examination that he did, the risk is very high. There's a possibility that things are wrong, hajaona. But in audit or financial statement, the risk is reduced because this guy had enough time to do a lot of job. So he's actually giving something that is very sure about. Kama ni mbaya aliona. Kama ni mzuri, he had the opportunity to see. So the audit risk is lower. Now, let's go back to this statement. So you're saying that these people, the first year they made a profit of sales of 9 million. They know very well that partnership is not mandated to do an audit, external audit. However, they are being tempted to do a review. But then they don't know the advantage that they will get from the review. Because when you do a review, you are going to pay the practitioner some money. But are you going to get any benefit from that? So they are asking themselves. Then John Matthew and David currently employ a part-time, partly qualified accountant. Remember that. They have employed somebody who is an accountant, who is partly qualified. Now, that person is called Mike Pesa, who has prepared the financial statement, who has prepared the statement of financial position as at the year end 2014. Mike Pesa also prepared by monthly management accounts. He also prepared monthly management accounts. So, by it means that, is it twice in a month? Maybe something like that, or a half monthly, maybe quarterly, or bi-monthly. So every quarter, not quarter, but every 2 weeks, anatengeneza management account, that is bi-monthly. No, management accounts, it is just like the normal accounts, but now it is being used by management for decision making. You give the report, they are able to analyze, make their own decision. But it is not quite comprehensive like the normal financial accounts. They have key areas that are expected by management. Now, this person is, of course, we are told that Mike Pesa is somebody who is partly qualified. So what does that mean? If you are not fully qualified, then there's a possibility they can make errors in our jury. Partly qualified, that's somebody who does not have enough knowledge in accounting. And this is the person they have employed. And this shows that the partners might not be having knowledge in accounting, Because wakiachia mtu mwenye hajakuwa fully trained afanye hiyo kazi, that means that hata hao wenyewe, they don't know what needs to be done. They depend on him. But maybe because they are trying to reduce the fee. Explain the potential benefits that the management will derive from a financial statement audit of the partnership. That is the question. Explain the benefits that the partners should expect. So you need to convince them to be able to go ahead with review engagement or the normal audit engagement. What are the benefits? Hata kama sio mandatory, bado inafaa waendelee kufanya. That's what they're asking. So I was saying that at your level, advanced level, they will not ask you directly. It is a topic number one over under assurance and non-assurance engagement. So these guys want to do a review or maybe audit. It is still under engagement. And that is why it is brought in this particular chapter. But now they are bringing it in a way where they're asking you, tell us the benefits of our insurance engagement. And to be particular in this case study. So from this case study, I can say that at your level, it is quite tricky, but it's also easy because you get everything. You don't even need to cram. Kila kitu utapata tu hapa. Number one, in this case, review engagement or even full audit will be able to help them know amount of profit that they are making. Remember, these partners, sometimes they have to share. At some point, they will be sharing profits. They have profit sharing ratio. So for them to be able to share profits, they need something like an audited account that shows the clear profit for the year. That will be the basis they will use to share profits. New query. Number two, they have told us that the management have employed somebody who is partly qualified, meaning that could be making some errors. So the auditor will be able to review the monthly by monthly management accounts and even help them identify some errors. Number two, from normal audit, we normally talk about two reports. We have the financial report and then we have management report, management letter report. Yani management letter report is zile ziko na findings, the points that you got when you are doing audit, utaweka hapo. Now, when an auditor comes, external auditor comes to perform audit, he'll be able to come up with some issues that will be able to tell them the weaknesses in their operations. Tawambia, internal control iko na shida. Hii inafaa ufanye hivi. That is another advantage. These guys also think of expanding in the future. Sindio, tumeambiwa hivyo. But when they want to expand, just like in the normal operation, they initially took loan from the bank. We are sure they're going to take another loan to open up or expand. Of course, the bank must require audited account. Sindio, that is another advantage. Watapeana hiyo. Look at those benefits. But again, because this particular guy, the accountant, is not fully trained, there could be some errors that is making in his report, not just the management report. Or even there's some reports that is not giving these guys. Like end of day, you should be able to generate a revenue report to give management. We have not been told that this accountant is giving the revenue reports. They are not able to know that every day report in terms of revenue and expenses. They are not controlling that. Now, in one of the reports that they should be giving management every day, but the partly qualified accountant doesn't know that. So we are saying that through the audit, the external auditor will advise the management and the accountant on some other reports that he might not be giving them so that he can start generating and giving them. Those are how many marks? So I was telling you at your level, it is just about thinking outside the box. Hawajaleta anything here, and they might not give you that, but they will give you something that relates. Then they want to see if you can be thinking outside the box like a manager or senior person, because you are already advanced. You have already advanced, and that is why you are in advanced level. Let me go to another area. I want to talk about audit risk. This is something that it never misses. I don't know how they set exam, but audit risk, nimeshindwa. Every year, wasipoleta wanaileta tena controls. Audit and controls, they normally bring. I don't know why, but risk is something that you cannot ignore. Now that I talk about audit risk, I say that audit risk is the risk that the auditor can give around conclusion, right? So we have elements of audit risk, or the items that when you total up gives us the total audit risk or total risk. So we have two types of risk. We have business risk and then the audit risk. Business risk only relates to the business institution or the company. Hiyo ni ya kampuni too. And then we have audit risk that is actually related to the auditor himself. So audit risk is the one for the auditor. It is the possibility or a situation where the auditor has given a wrong conclusion. He's giving a good report when things are wrong. Things on the ground are wrong, but he's giving a good report. But on the business risk, it is the risk that affects the normal operation. So let's look at the two. They are always set questions on the same. So we have audit risk. And then we have business risk. So audit risk, there are only three types or elements or examples. In example, ukisikia tu mention to audit risk, think about those three. Even if they give you a case study at your level, Nico, at your level, they will tell you that you see there's a case study like this, like this. Can you identify and tell us how the auditor will manage or deal or identify the audit risk? Once ukisikia to audit risk, just know that there are those three, tafuta vile utazipata and how you will deal with them. But there are only three. And the first one is called inherent risk. The second, we have one that is called control risk. And then we have mutation risk. Those are the elements or examples or types of audit risk. I don't know else what term they can use, but ukisikia to audit risk, think about these three. Then now we have business risk. This is the normal one that you know. We have financial loss or financial risk. We have operational risk. We have something like maybe compliance risk. Which else do you think we have? Reputational. We have reputational risk. These ones affect the business, so don't mix them up. This is a biashara too. The business will lose money, maybe through fraud, that is financial risk or financial loss. Operational, where the operation has been affected, like COVID-19 affected the operations, that is operational risk. And this one can always be controlled or managed by a good business plan. We call it business continuity plan, BCP. When you have BCP, business continuity plan, you need to plan as a manager or the owner of the business, you need to plan in advance. In case this happens, how can I continue with business? So business continuation, business continuity plan, you need to have a plan that ensures the business continues. Most people don't even think about that. And even a serious organization should be having a standby CEO